All right. Hey, trust you are doing well and you have had a great week. We're just wrapping up the week here. Had a great team meetings, a lot of productivity, a lot of advancement forward on various projects that we're working on. Wanted to share with you some of our discussions as we do each week. What we've been talking about is the rise in interest rates or mortgage rates, specifically the 10-year Treasury over the last basically 30 days, probably 45, 50 basis points. And, you have to understand long-term rates. Now, you got two things going on. You have the Fed funds rate where they've put that on pause right now at that, 5.25 range. That affects short-term lending. It is not a driver for like the market-based mortgage rates and 10-year Treasury. That's driven by market forces. And we've seen the market forces drove up the 10-year Treasury by about 45 to 50 basis points in the last, probably 4 weeks. And then we've seen a good number of volatility in the last week on those numbers. And so there's two thought processes. There were some people say, God, what's happened with that? One, there was stronger economic news that came out with respect to the jobs data. It was foretelling that, the economy is still staying in there stronger. And so then with that, the market forces are saying, okay, hey, that bonds currently offer a little bit less of an attractive opportunity. More money's pulling away from the bonds. And so as a result, the price of the bond, goes down and then the yield goes up. And that's, the inverse relationship of it. The second component or thought process is that there is a risk premium or yield premium that people are looking for now that's higher than what it used to be. And so, historically, when you look at like the 10-year Treasury and you compare 30-year mortgages, there was a delta difference of about 1.7%. It's substantially higher than that now, probably by 3%. Your current 30-year mortgage is 8.25 right now, depending on the lender and various factors. And then your 10-year Treasury is at about 4.84 right now as we speak. In the recording of this. So I want to take a look at two of those factors. So right now, what that means for us and for you in the marketplace, it's a relative certainty, if you will, or expectation that is reflected that interest rates are going to be higher for longer. That, you've got an economy that's stronger. GDP numbers just came out yesterday at, 4.9% projected growth. And so that's a stronger number than what was expected for sure. You had the jobs report that came out that is a stronger number than what is expected. And so there's a surprising amount of resiliency still that's in the economy, given the fact that the Fed dramatically raised rates higher than they've done in the last 40 years, as quicker than they've done in the last 40 years. And the expectation was that it would be slowing the economy down quicker and sooner. And then with that slowdown, you'd have an ability to reduce rates, or they would begin to reduce rates. And then as the economy slows down, more money would pour into, bonds, which would typically also raise the price of the bond and then also lower the yield. So that's part of what's going on right now. So what does that mean for us as an investor, and then even specifically a real estate investor? There is an expectation where interest rates are going to remain higher for longer, because we really do need to see a form of economic slowdown in order for the long-term rates to come down. Because again, the Fed does not control the 10-year Treasury or mortgage rates. That's a market force. And so as the economy slows down, historically, more people transition portfolio monies into bonds. And then the more money that comes into bonds, the price goes up, it's bid up. And as the price of the bond on a 10-year Treasury is bid up, the yield comes down. And, it also is not a favorable thing that our economic or leadership of this country has probably not done what you'd call a great job. There are some disenfranchisement with, the various players around the world where the U.S. Market is less favorable to them, China, Japan, and some of the other areas. Japan's actually kind of making a turnaround there for their country, and so that makes their local investments more appealing. So that being said, we look at those factors. The other factor is kind of that risk premium that is what I discussed or alluded to earlier. I would also believe that there is a bit of a higher risk premium right now, and that's reflected in the mortgage rates, that banks are looking for a bit higher of a return than they historically have, because also historically in times of uncertainty, economic uncertainty, there is a reasonable justification that they're having for that, because there could be a recession, could be more defaults, could be more people that couldn't pay their mortgage. That's part of that equation, and that's why you also see these 8.25 interest rates. So again, what does that mean for us? It means, I think, for us as investors, that we have to be recognize that we're going to be dealing with an interest rate environment that's going to be higher for longer. We've got to be more conservative in scrutinizing in the properties and projects that we're underwriting, which we historically have and continue to do so and will be. But we also have to be more correct also in assumptions where, some of the properties we've sold this year, we've sold 6, we have one more that we're selling. Realistically, there's no doubt the buyers anticipated, hey, I'm buying it this year, 2023. I'm going to have, lower rate opportunities by 2024. I would think it is that probably we don't see rates moving down till, second half of 24 and then into 25. And now that's also going to be dependent upon, what type of economic slowdown we really face and we really see. And then that also will begin to guide the risk premium or yield premium that people are looking for as we see what is the reality of what's going on in the economy this next year in 2024. So we're going to continue to keep our eyes on these things. These are things that we look at. And again, for us, when we look at their secondary effects, right? Like that when we look at and think about, the GDP growth, inflation, we think about the recession. How does that translate into more vacancy and turnover? How does it translate to higher R&M costs, repairs and maintenance? How does it translate into occupancy numbers? And those are all things that we look at and discuss. And also, I would say for you and your business, you got to look at it to say, okay, what does that mean for us? If you're going to be facing higher interest rates over the next 12 months, what does that look like? And also, if we are in a new normal that's a higher rate bracket, rates are going to come down, but it's not like they're going to come down to back where they were. So these are all things that you got to take into consideration and then say, well, what does that mean? What's the next step? What's the impact? So, hey, thank you so much. Have a blessed and victorious week, for this is the week God has ordained for you.